For number 7 asks for the variance of a portfolio, and to do that I'm going to show you first what the formula would be. We have Esther and Jude stock, and I'm going to use those subscripts here in the formula. We're going to take the squared weights times the variances of each. We start with Esther since it was first. And you have to remember the product of the weights. We have a correlation term between Esther and Jude. Sorry, not squared. And then we have sigma j. Note that the correlation times the product of the standard deviations is the same thing as covariance. And so if the problem told us covariance, we would just plug that in place of those 3 items, but the problem does tell us correlation, so I'm going to use this formula. Now we just plug in. Notice that I'm leaving the weights as a fraction or decimal, and I'm putting the standard deviations in as a percentage. Right, now this 0.3 is that correlation, 0.3. And so that will be 440.8. To get the standard deviation, we have to get the square root of the variance, and that will be 21%. We see there's the option C. All right, let's go down to number 8 now. Number 8 is a Chapter 1 problem. And before we get to the bonus, let's just do the problem that's asked. It says Sarah has an ownership in C Corporation. And we want to know her after-tax income. Now the way C Corporation works is that it's taxed twice, and you have to know what's taxed. We have EBIT, and they have an interest expense. We have to subtract the interest expense before we can calculate taxes. So there'll be an $800 million of earnings before taxes, and then 35% will be taxed, so 65% will be left over. And then it tells us that they pay out 30% as dividends, so now I'm up to the dividends that are paid out to all shareholders. The shareholders will pay a tax rate of 25%, and 75% will be left over. Now what's Sarah's portion? Well, she owns 100 shares out of the 100 million shares. You see the millions will cancel out with the millions here, and we'll have the dollar amount. Plug all that into your calculator and you'll get $117 per share. So the answer would be D. Now, what if it was a S corporation? If the question asked was the S corporation, it would need to also give you this information. It would need to give you the personal wage tax rate. So let's assume it's 40%. And the other thing that is a feature of the S corporation is that all earnings have to be paid out as dividends. So we'll have to change the 30% here payout rate to 100%. All right, now let's go calculate the after-tax earnings under this scenario. The corporate earnings would still be $800 million. Now there would be no corporate tax rate, but all of it would be paid out as dividends. and then 40% of those earnings will be paid to the government in taxes, and then 60% will be left over. Sarah's portion again would be 100 shares out of 100 million shares. We have the millions and millions cancel out, and we have $800 times 0.6. We'd have $480 being the after-tax earnings. It is one reason why it's so much larger is that all the earnings have to be paid out. So we see 0.3 being paid out here, and then we have 1.0 paid out here, and again because of that. So know how to calculate the after-tax earnings, and also therefore you'd also be able to know what the total taxes are under an S corporation and a C corporation. Okay, number 8 is a question about what's the better project to take. And we have two projects here for this ice cream manufacturer. We have the heartburn, which would cost $200,000 to develop and then result in $500,000 of positive cash flows year 1, 100 in year 2, and 25 in year 3. Or we could take Hillary Celery, which would also cost $200,000 up front to develop, but then $300,000 of positive cash flows in year 1, $250,000 in year 2, and $150,000 in year 3. The cost of capital for the company is 12%. Now the question is, what flavor should be offered, which means which is the better project? And to answer that, we have to calculate the NPV of both. So the NPV of the heartburn, formulaically, would be the sum of the discounted values of all of the cash flows, which can more easily be found using your NPV function of your calculator. Which will give you 3,043,942. Hillary Celery on the other hand, look back to see the cash flow 250 and 150 will be 373,923. So we see that Hillary Celery has the higher NPV. So we can immediately eliminate options D, B, A. Now it's between C and E, and the difference is what is the IRR of this project. To get the IRR, simply put in the cash flows into the IRR function of your calculator, which is 121.66%, or rounded to 122%, and we see that that is answer C. Note that the higher IRR project is not necessarily the better IRR project, nor assume that the lower IRR project will be better either. To know that which is best, you have to calculate the NPV, and then we're just simply reporting the IRR of that better project. Alright, number 10 is a chapter 9 problem, and there's lots of parts to it, and I'm going to go through all of the parts even though we're answering just period 10 here. So it's a multi-year project, so we're going to put in all the components of free cash flow of the project. So we got EBIT times 1 minus the tax rate, which is called net unlevered net income. We add back depreciation. We subtract capital expenditures, subtract change in net working capital, and all of that sums up to free cash flow. Alright, let's look at the information. So let's just go in order here. We have this manufacturer owns land it could sell for $1 million after taxes, and it's going to use this land for the project. That is an opportunity cost, so we have to include it. Alright. this is an opportunity cost. And then it tells us that the plant itself would cost $10 million to build. So that is clearly a capital expenditure in year 0. And then it will be straight line depreciated to 0 over 10 years. So that means that after year 0, in year 1, I'm just going to do $10 million in my head. We have a depreciation of $1 million. Year 2, $1 million, and all the way down to year 9. But the year that we're really interested in is year 10. So $1 million in each one of those years. Continuing in the information that's here, it says it'll produce goods, it'll generate $2 million in year 1, and that revenues grow at 3%. We have a shutdown value, and then we have operating expenses of 60% of revenues. So let me use the operation stuff first. So the EBIT in the first year is $2 million times 1 minus 0.6, because 60% is the costs. And then we have to subtract the $1 million of depreciation. And then we have what's left over after taxes, which is 35%. And the $2 million grows at 3% a year. So that means in the last year, it's 1.03 to the 9 times $2 million. We have the leftovers after the variable costs are paid of 60%. We subtract the last year's depreciation of $1 million. Then we have to tax all of that. So all of that will be $2,848,000. I'm sorry, not 2 million. Misread the decimal, or the decimal is 28,482.06. Alright, let's go back to the information now. We had just passed over this information that the plant will be shut down in 10 years and sold for $2 million. So that is a salvage value, and it's a reverse capital expenditure. So $2 million will be received by the company at the end of the project, but then they have to pay taxes on it because the book value is 0 and that they're selling it at this gain of $2 million. And so the after-tax salvage value will be $1.3 million. Alright, continuing in the information, it says the new operating plant will require $500,000 in cash. That's in addition to net working capital, because that's in addition to current assets, but then the addition of $400,000 in accounts payable increases the current liabilities. So the change to net working capital is negative, or the change to net working capital is $100,000, which has a negative impact, and the problem tells us that it will be recovered. So it will be recovered at the end of the project. Last piece of information we've not considered is widget makers paid Booz Allen Hamilton $90,000 to generate these forecasts. The key is that they paid them. So this is a sunk cost. This consultant fee, we do not include it. Alright, now we're ready to answer this question of what's the period 10 cash flow. Well, the period 10 cash flow is here, so let's just concern ourselves with summing up these numbers. The $28,482, the depreciation, adding back the recovered net working capital. If you sum across, you get $2,428,482 and 6 cents. And we scroll up to find that. We see there it is, $2,428,482.06 is the period 10 free cash flow. Number 11 is actually a chapter 11 problem. We have 4 years of returns. We're asked what's the standard deviation, and then as an extra we're asked what's the geometric mean. So let's do the standard deviation first. To do that, we have to find out the arithmetic mean. So that's just the sum of all the returns and then divide by 4. So the arithmetic mean is 5%. The variance is the sum of the squared deviations from the mean divided by the observations minus 1. So remember that minus 1. So we sum everything in the numerator, divide by 3. We get 316.6667. The standard deviation is the square root of all that. And we get 17.80%. Scroll up to find the option there, and we see that it's B. Now let's do the extra, is what's the geometric mean. To answer geometric mean, we add the returns to 1. So 1 minus 0.1 is 0.9, 1 minus 0.05 is 0.95, and then 1 plus 5% is 1.05, and then we raise it to the 1 over number of periods and subtract off the 1. So if you do all that, you get 1.3 times 0.9 times 0.95 times 1.05 raised to the 0.25 minus 1. I get 3.94% as the geometric mean. Right, so be clear on the difference between arithmetic mean. Arithmetic mean is what's used to calculate variance. Standard deviation is square root of variance, and then if you're asked for geometric mean, that's really separate from all of that. You have to calculate it this way, and geometric mean is usually less than the arithmetic mean, and that's because you have some years of losses typically. All right, number 12. We have another free cash flow problem. Now, one little thing here that we need to clarify is that the intention here of this, what's called operating margin, is that it's EBITDA to sales. Right? You didn't need to know that. You would just on the exam, if you were given this problem, we would tell you to make that assumption. Let's review the formula for free cash flow. The unlevered net income, add back depreciation, subtract capital expenditures, subtract change to net working capital. So we have $2 million in revenues. The margin is 20% of that, so EBITDA is 20%. We have to subtract depreciation, which we're told is $200,000. And then times 1 minus the tax rate. Add back depreciation, subtract the capital expenditures, so it says that it will purchase new equipment worth $400,000, and then we have to add change to net working capital. So we have accounts receivable going up by $50,000. You need to know that that is a current asset. Accounts payable go up by $25,000. You need to know that's a current liability, so that's minus $25,000. And so we have 2 million times 0.2 minus 200,000 is 200,000 times 0.75. Add back the 200,000, subtract the 400,000, subtract 25,000, and that all results in negative $75,000. The answer is E.